Let's look at the tape right now. Alibaba Group Holding Limited is flashing across terminal screens, moving through a high-stakes channel that forces retail investors into endless loops of anxiety on financial TikTok and X. Standard market media reduces the entire narrative to a tired headline about consumer sentiment in Shanghai or old regulatory overhangs from yesteryear. They look at the ticker through a myopic lens, treating a multi-hundred-billion-dollar technological titan as if it were just another digital bazaar trying to survive local discount wars. But while retail traders obsess over daily macro noise and minor margin contractions in core retail, they completely miss the fundamental physics and structural reality governing the modern AI and infrastructure stack. Underneath the consumer-facing apps lies an enterprise powerhouse facing a massive physical and computational bottleneck, the absolute thermodynamic and interconnect limits of scaling high-density domestic AI clusters under strict semiconductor export constraints. When you look at how large-scale enterprise data centers handle parallel processing, the real barrier isn't just acquiring silicon, it is managing the staggering thermal dissipation and interconnect latency across millions of heterogeneous compute nodes. Alibaba Cloud isn't merely renting out virtual servers, it is orchestrating a massive proprietary transition toward full-stack artificial intelligence powered by the Qwen family of large language and multimodal models. While Wall Street analysts obsess over quarterly gross merchandise value percentages, institutional heavyweights are quietly positioning themselves around the company's proprietary data center architecture, custom chip development via Pingtouge, and high-bandwidth memory optimization. They realize that the true value driver isn't just selling more consumer goods online, it is locking in enterprise customers across Asia through high-margin cloud infrastructure and localized intelligence that Western alternatives cannot touch due to regulatory and geopolitical divergence. The daily trading volume in BABA tells a story of relentless tug-of-war between short-term emotional sentiment and calculated multi-year accumulation by smart money. Every time macro jitters surface or minor regulatory headlines hit the newswire, retail algorithmic sentiment triggers panic selling, driving sharp intraday pullbacks that shake out weak hands on margin. Yet, if you peer beneath the surface order flow and institutional block trades, a very different picture emerges. Mega-cap institutional allocators use these liquidity drops not to exit, but to systematically accumulate shares at historically depressed price-to-earnings multiples compared to their Silicon Valley peers. They understand that the structural free cash flow generation of Alibaba's core commerce engine, combined with the explosive inflection point in cloud AI adoption, creates a massive asymmetric risk-reward profile. This divergence between emotional retail panic and cold, calculated institutional accumulation is where fortunes are built in global equities. While retail participants chase high-beta momentum stocks in the U.S. market, institutional desks are quietly locking in dividend yields and aggressive share buyback programs that systematically reduce the total float. Think about your own portfolio positioning right now. Are you letting short-term price chop shake you out of a generational asset, or are you scaling in during these engineered pullbacks while the smart money absorbs the float? Drop a comment below with your current share count, or let me know whether you are still waiting for a deeper macro dip before pulling the trigger. To truly grasp where Alibaba is heading, we have to strip away the outdated historical framing that treats the company as a mere clone of Western e-commerce giants. Founded back in 1999 by Jack Ma and his co-founders as a humble B2B marketplace, the company evolved through distinct evolutionary epochs. For a long time, public perception was anchored to the classic consumer-to-consumer and business-to-consumer cycles of Taobao and Tmall, marketplaces that revolutionized retail across China. But pigeonholing Alibaba as a legacy online retailer completely ignores its structural transformation into an integrated digital infrastructure holding company. Today, the business operates through distinct, streamlined pillars designed to unlock some of the parts value. The Taobao and Tmall Group, Alibaba International Digital Commerce spanning platforms like AliExpress and Trendyol, the logistics powerhouse Cainiao Smart Logistics, Local Services Group, Digital Media and Entertainment, and crucially, the Cloud Intelligence Group. The modern demand vector driving Alibaba is no longer just gross merchandise value from apparel or electronics. It is the digitization of enterprise workflows and the monetization of AI at scale. Alibaba Cloud has matured from a simple storage utility into a comprehensive public and private cloud provider offering elastic computing, advanced database management, big data analytics, and machine learning platforms utilized across diverse industries from manufacturing to finance. By fusing its sprawling logistics network, which leverages artificial intelligence and Internet of Things routing to ensure hyper-efficient fulfillment, with a full-stack AI ecosystem driven by proprietary large language models, Alibaba has constructed a self-reinforcing economic moat. Merchants don't just sell on its platforms, they manage their supply chains, execute digital marketing, analyze customer behavior, and scale enterprise software solutions entirely within the Alibaba universe. Looking out over the multi-year horizon, Alibaba sits at the intersection of powerful secular growth catalysts and distinct structural headwinds. On the catalyst side, the rapid enterprise adoption of localized artificial intelligence models, combined with continuous optimization of capital allocation among global cloud spenders, provides a robust tailwind for Alibaba Cloud. As companies across Asia race to integrate generative intelligence into their operational frameworks, demand for high-performance cloud compute and specialized machine learning tools will continue to accelerate. Furthermore, aggressive capital allocation strategies, including major share buyback initiatives and strategic capital structuring, signal management's unwavering commitment to enhancing per-share value for long-term investors. However, navigating this landscape requires a clear-eyed assessment of risk. Supply chain complexities, evolving geopolitical boundaries, and regulatory scrutiny across international jurisdictions remain permanent variables that can introduce sudden volatility. The imperative to design and deploy homegrown semiconductor solutions to bypass external hardware restrictions places an enormous R&D burden on the firm's engineering teams, testing both thermal management thresholds and manufacturing yields. Yet, looking past short-term price noise is essential for any serious allocator. In the grand arc of technological evolution, temporary macroeconomic friction and sentiment-driven drawdowns pale in comparison to the enduring demand for automated commerce, intelligent logistics, and scalable cloud infrastructure. The market will eventually reprice these assets to reflect their true underlying cash-generating power, rewarding those who maintain long-term conviction while the crowd remains distracted by the daily tape.